Hey, what's going on YouTube? And welcome back to Tech Conversations. Firstly, if you haven't already, make sure to check out LuxAlgo. LuxAlgo is the #1 AI agent to help you find strategies, powered by some of the best trading indicators and used by over 15,000 traders, including myself. And I've actually covered many of their premium indicators in the past on my channel. But right now, if you sign up to LuxAlgo by using my link in the description below, you can get up to 50% off their premium indicators. Keep in mind you can also get 30 days risk-free, so why not try them out? So go ahead and check out LuxAlgo. I'll put a link to them in the description below. Also, make sure to check out the Discord, completely free to join. I'll put a link to it in the description below as well. We're at over 8,000 members in here, so thank you to everyone that's joined our Discord. Now let's get right into today's video. So, the stock market has been very volatile recently, and so today I want to talk about how we can make money both ways on QQQ or any other security with options. So our goal here today will be to profit from the price going up or down. So that means that the forecast for the security you select should be high volatility. We are going to want the security to move outside of a range that we define, as you will see here shortly. So first, find a security where you have that forecast, where you believe it will make a rather large move up or down. Again, for today, I will be using QQQ. Keep in mind, everything I'm showing you here today is just an example to show you how this strategy works and how you would set it up. So let's go into the options here for QQQ. So firstly, we want to go ahead and start by selecting an appropriate expiration date here. In other words, this move outside of this range that we are going to determine should happen before our expiration. Now, QQQ has expiration dates that expire every single day. So I'm just going to go ahead and leave it as November 24th. Again, this is just an example to show you how this works. So I'm just going to leave it as November 24th, but again, you would select the appropriate expiration date for your situation. Now, we're going to start with calls here. So notice that we are on calls here. And what we want to first do here is if the share price goes up, we want to determine what price do we believe it will go above. Okay, so let's say if it goes up in price, let's say that we believe it will go above $600. Again, I'm just making these numbers up. But let's just say we believe it'll go above $600 if it goes up in price. So then what I'm going to do is I'm going to start by selling a call with that strike price. So I'm going to switch over to sell here. And again, we're on calls. And I'm going to start by selling a call at the $600 strike. So that's the first step here. Now next, I'm going to switch over to puts now. And so now what we want to do is if the share price goes down instead, we want to determine what price do we believe it will go under. So again, let's just say if it goes down, we believe it will go under, let's just say 580. Again, this is just a random number I'm making up. So now what I want to do, so I want to go ahead and sell a put with that strike price, with a strike price of 580. So I'm going to scroll down here. So here's the put with the 580 strike. So now I would want to go ahead and select this here. Now we're going to switch back over to calls here. So now we need to buy a call. So I'm going to switch over to buy now here. And again, we're on calls. Now we need to buy a call with a lower strike than the strike of the call that we are selling. So here's the call that we're selling, the $600 strike. So now we want to buy a call with a lower strike. Now the strike should still be higher than the strike of the put that we're selling, but lower than the call that we're selling. So let's just say I go ahead and I buy the call at the 595 strike. So this right here. So I'm going to go ahead and add this here. So far we're selling a call, we're buying a call with a lower strike, and we're selling a put with an even lower strike. So now finally, I'm going to switch over to puts again. I'm going to stay on buy here. And so now I'm going to also buy a put with a higher strike than the strike of the put that we're selling. And it should have a lower strike than these calls over here. Now, this one is very important here. This is very important. The next thing I'm going to tell you here. Notice that the call that we're selling and the call that we're buying, they're $5 apart in terms of the strike price. This is a $600 strike. This is a $595 strike. That's $5 apart. So that also means that for the put that we sell and the put that we buy, they also need to be $5 apart. And so if I'm selling the put at the 580 strike, that means I have to buy the put at the 585 strike. So I'm going to scroll down. I'm going to buy the put at the 585 strike, right? So now the calls that we are selecting here, they're $5 apart from each other, and the puts that we selected are $5 apart from each other. That's very important. Make sure that you're doing that. Now we have Robinhood's P&L chart down here that we can use, and you can already see we're going to be able to make money both ways. However, I'm going to go ahead and use Option Strat to get a more comprehensive view on what's going on here. So let's go ahead and let's visualize this trade on Option Strat here. So I'm going to go over to Option Strat. I'll put a link to Option Strat in the description below. This is a really great options visualization tool. And what that means is it lets you visualize an options trade before you even enter it. So let's go ahead and let's just go to build here. And again, we started with a call, so I'm just going to select call here. So the first thing we need to do here is go to the security we're using. So again, we're using QQQ for today's example. Again, this is for any security, right? This is literally just in general here. And so I'm going to go ahead and select the expiration date we selected, November 24th. So that's already selected here. And so remember, we first started by saying, okay, if the price goes up, what price do we believe it will go above? And we said, let's just make up a random number. Let's just say we think it's going to go above $600. And so we start by selling a call at that strike. Now, obviously, when you're setting this up, you should actually do some analysis to determine all these different numbers. But again, since this is just an example to show you guys how to set it up, I'm just selecting random numbers here. So we said 600, so we started by selling a call at that strike. Now we said, okay, what if instead the price goes down? What price do we believe it will go under? And again, I just made up a random number, but you would actually do analysis to figure out what that number is. So I just said, let's just say we think it's going to go under 580. So let's start by selling a put at that strike. So I'm going to add a put to sell here, and I'm going to go to the 580 strike. So that's what we have so far. Then I said we need to buy a call with a lower strike than the strike of the call that we're selling. So let's go ahead and add buy call here. And I said, let's just do the one at the 595 strike. So right here. And then I said, these are $5 apart from each other in terms of the strike price. So now we also need to buy a put. And then that put that we buy and the put that we sell, those also then need to be that same distance away, which is $5 here. So I'm going to go ahead and add buy put. And so that means I have to buy the put at the 585 strike. So this is the trade here. And let me zoom out a little bit here. So notice here, right, we get everything, all the details we need. So we're entering this for a debit, 247 for this example. Whatever your debit is, that's what your max loss will be. So again, 247. Max profit for this example is 253. If you have the premium version of Option Strat, you can see what your chance of profit is. So according to Option Strat, my chance of profit is 49% here. And then we have our break evens here. So outside of these two, and the reason we have two here, right, is because we can make money up or down here. So let's talk about where some of these things will happen. So our max profit will happen if at expiration the stock is either above the strike of the call we sold or below the strike of the put we sold. So again, meaning we can make money both ways. We can make our max profit both ways. So if at expiration QQQ is above $600 or below $580, then we can make our max profit of $253. Now our max loss is going to happen if at expiration the stock is between the strikes of the options that we bought. So if at expiration QQQ is between 585 and 595, we're going to hit our max loss here. And then in between, the put that we bought and the put that we sold and the call we bought, call we sold, you may either, lose a little bit less than this or make a little bit less than this. It depends kind of where you are at. You can see your break evens here, right? So this is called the reverse iron condor. And it is the strategy of choice when the forecast is for a stock price move outside of the range of the highest and lowest strike prices. So if you don't think that is going to happen, if you don't think the security that you're selecting will be above the highest strike or below the lowest strike, this strategy may not be appropriate for your situation. But if you think that will happen and it's going to be very volatile, this could end up working for you. So anyways, if you have any questions, feel free to leave them in the comments section below. Check out the Discord, link to that in the description below. Hope you enjoyed the video. Let me know what you guys think. I will see you guys next time.